This is Investing Counsel, and in this video, we are going to talk about pros and cons of investing in rental properties. Investing in rental properties can be an excellent way to generate passive income and build long-term wealth. However, like any investment, it's important to understand the potential pros and cons before diving in. In this video, we'll explore the advantages of investing in rental properties, the disadvantages that come with investing in rental properties, and the important factors to know before investing in rental properties so that you can make an informed decision. If you are ready, let's start with the pros. The first one that comes to mind is passive income. One of the most significant advantages of investing in rental properties is the potential for passive income. Once you've acquired a property and have tenants in place, the rent payments can provide a steady stream of income each month. If you have multiple properties, this can add up to a significant amount of passive income. Of course, being a landlord involves more than just collecting rent checks. You'll also need to manage the property, maintain it, and ensure that the tenants are complying with the lease terms. However, with proper management and screening, investing in rental properties can be a relatively hands-off way to generate passive income. Now, the question is, if the income from renting a property is truly passive? Well, passive income from rental properties may not be entirely passive. While you may not have to work a traditional 9-to-5 job to earn the income, you'll still need to invest time and effort in managing the property. For example, you'll need to find and screen tenants, handle maintenance requests, and ensure that the property is in compliance with local laws and regulations. If you hire a property manager that can take care of these activities, then this income can become an entirely passive income. The second one is appreciation. Another advantage of investing in rental properties is the potential for appreciation. Over time, real estate tends to increase in value, which means that the property you buy today could be worth more in the future. This can allow you to sell the property for a profit or refinance it to access equity. Does appreciation follow a simple process in real estate investing? Of course, there are important factors that can contribute to real estate appreciation, such as location, supply and demand, economic factors, infrastructure development, property condition, property improvements, and interest rates. The location of a property is one of the most important factors for real estate appreciation. Properties that are located in desirable areas, such as those with good schools, low crime rates, easy access to transportation, and amenities, tend to appreciate more over time. Real estate is subject to the laws of supply and demand. If there is high demand for properties in a particular area and the supply is limited, property values will increase. Conversely, if there is an oversupply of properties in an area, property values will decline. The overall economic conditions of a region can also impact real estate appreciation. If the local economy is strong and there is job growth, this can lead to increased demand for housing and appreciation of property values. Similarly, a weak economy with high unemployment rates may result in lower demand and slower appreciation. The development of new infrastructure, such as highways, public transportation, and new commercial centers, can increase the value of properties in the surrounding areas. The condition of a property can also impact its appreciation. Well-maintained properties that have been updated and renovated tend to appreciate more than those that are in poor condition. This is especially true if the updates or renovations are in line with current market trends and appeal to potential buyers. The cost of borrowing money to purchase a property can impact real estate appreciation. When interest rates are low, it can make it easier for people to afford to buy a home, increasing demand and driving up property values. The third advantage is tax benefits. Investing in rental properties also comes with some tax benefits. For example, you can deduct mortgage interest, property taxes, and other expenses from your rental income. Additionally, if you have a rental property that isn't making a profit, you may be able to use the losses to offset other income. Let's dive into this topic a little more. The main important tax benefits in real estate investing are depreciation, mortgage interest rate deduction, property tax deduction, 1031 exchange, and deduction of expenses. Depreciation allows investors to deduct the cost of the property over its useful life as a tax write-off. Based on the current code, the IRS considers the building portion of a property to have a useful life of 27.5 years, so investors can deduct 1/27.5 of the building's value each year as a non-cash expense. This can result in significant tax savings, even if the property is actually appreciating in value. Remember, the IRS may change this code. A good tax benefit of real estate investing is the ability to deduct the interest paid on a mortgage. This applies to any loans taken out to finance the purchase, renovation, or improvement of the property. The interest paid on the first $750,000 of the mortgage is tax deductible, as of the current tax code. Property taxes paid on real estate investments are also tax deductible. This can result in significant savings, especially in high-tax areas. A 1031 exchange allows investors to defer paying capital gains taxes on the sale of a property by using the proceeds to purchase a like-kind property. By using this strategy, investors can continue to defer taxes as they roll over the proceeds into new investments, allowing them to grow their wealth and defer taxes for years. Expenses related to the maintenance, repair, and management of real estate investments can also be tax deductible. This can include things like property management fees, maintenance costs, and repairs. Overall, these tax benefits can make real estate investing a smart financial move for those looking to maximize their returns and minimize their tax burden. It's important to work with a knowledgeable and certified tax professional to make sure you're taking full advantage of all the tax benefits available to you while staying compliant with current tax laws. Finally, the fourth one is having control over the investment. When you invest in rental properties, you have a high degree of control over the investment. You can choose the property, the location, and the tenants, and you can make improvements to increase the value. As a real estate investor, you have the ability to choose the specific properties you want to invest in. You can select properties that align with your investment goals and use data and research to find the best deals and the best markets to invest in. Once you own a property, you have control over the improvements that are made to the property. This includes both minor upgrades and major renovations, which can increase the value of the property and attract higher quality tenants. As a landlord, you have control over the rental rates you charge your tenants. You can set rents to ensure that your properties remain competitive in the market, while also generating enough income to cover your expenses and provide a return on your investment. You have the ability to screen potential tenants to ensure that you select the best possible renters for your property. This can help reduce the risk of problem tenants and non-payment of rent. You also have control over the day-to-day management of your rental properties. You can choose to self-manage your properties or hire a property management company to take care of things like rent collection, maintenance, and repairs. This level of control can be appealing to investors who want to have a hands-on approach to their investments. Now that we discussed the advantage of investing in rental properties, let's explore the cons. Are you ready? Let's go! The first disadvantage is high upfront costs. One of the biggest drawbacks of investing in rental properties is the high upfront costs. Not only do you need to have a significant amount of cash to make a down payment, but you may also need to pay for closing costs, inspections, and repairs. Additionally, if you're financing the property, you'll need to have a good credit score and a solid financial profile to qualify for a loan. In order to purchase a rental property, you'll typically need to make a down payment of 20% or more of the property's purchase price. This can be a significant upfront cost, especially for properties in high-priced markets. Depending on the condition of the property, you may need to invest in renovations or upgrades to make it suitable for rental. This can include repairs, upgrades to plumbing, electrical, or heating systems, or cosmetic upgrades. If you choose to hire a property management company to handle day-to-day operations of the property, you'll need to budget for their fees. This can range from 5 to 10% of the rental income, depending on the company and the location. The second disadvantage is maintenance and repairs. When you own a rental property, you're responsible for the maintenance and repairs. This can be time-consuming and costly, especially if you have multiple properties. You'll need to budget for routine maintenance, such as lawn care and cleaning, as well as unexpected repairs, such as a leaky roof or a broken appliance. The repairs are usually due to tenant damage and replacing appliances or systems that wear out over time. Now let's talk about the third disadvantage, tenant turnover. Another potential downside of investing in rental properties is tenant turnover. When a tenant moves out, you'll need to find a new tenant to fill the vacancy. This can be challenging and costly, especially if the property sits vacant for an extended period. Additionally, you'll need to screen potential tenants to ensure that they're responsible and reliable. Let's talk about it more. When a tenant moves out, you lose the rental income from that unit until you find a new tenant. This can be particularly problematic if it takes a long time to find a new tenant, leaving you with a vacant unit and no rental income. This can lead to inconsistent cash flow. When a tenant moves out, you may be left with a gap in your rental income until you find a new tenant. This can make it difficult to plan your cash flow and budget for expenses. This turnover increases your risk as an investor. Every time a tenant moves out, you run the risk of not finding a new tenant quickly or finding a tenant who doesn't pay rent on time or damages the property. This can lead to higher vacancy rates and increased expenses. You may need to spend time and effort advertising the unit, showing it to potential tenants, and screening applicants. This can take time away from other aspects of your business or personal life. Tenant turnover can be expensive. You may need to clean and repair the unit, repaint the walls, and replace any damaged or worn-out items. You may also need to advertise the unit and pay for background checks and other tenant screening costs. All of these costs can add up, reducing your overall profitability. So, tenant turnover can be a significant disadvantage in investing in rental properties. It's true that some tenant turnover is inevitable, but taking steps to minimize turnover and attract reliable, long-term tenants can help to mitigate some of these challenges. The final one from our list is market volatility. Real estate markets can be volatile and property values can fluctuate. This means that the value of your rental property could decrease, which could impact your ability to sell or refinance the property. Additionally, economic factors such as job losses or interest rate increases could impact the demand for rental properties and your ability to find tenants. For example, a strong economy with low unemployment and high consumer confidence can lead to increased demand for real estate, which can drive up property values. On the other hand, a weak economy with high unemployment and low consumer confidence can lead to decreased demand for real estate, which can drive down property values. Similarly, changes in interest rates can affect the affordability of mortgages, which can impact demand for real estate. If interest rates are low, more people may be able to afford to buy homes, leading to increased demand and potentially higher property values. Conversely, if interest rates are high, fewer people may be able to afford to buy homes, leading to decreased demand and potentially lower property values. In addition, local factors can also influence property values. For example, if there is a high demand for housing in a particular area, property values may increase. Conversely, if there is an oversupply of housing in an area, property values may decrease. So, it's important for you to be aware of the factors that can affect property values and to monitor market conditions closely in order to make informed investment decisions. In conclusion, investing in rental properties can be a lucrative investment strategy, but it's not without its potential drawbacks. Before making any investment, it's important to do your research, understand the market, and weigh the potential pros and cons. If you're willing to put in the effort to find the right property and manage it well, investing in rental properties can provide a reliable stream of passive income and long-term wealth building. Also, make sure to consult with a lawyer and accountant to help you make informed decisions, avoid legal and tax pitfalls, and maximize the returns on your real estate investment. Let's summarize what you learned in this video. In this video, you learned the advantages of investing in rental properties, the disadvantages that come with investing in rental properties, and the important factors to know before investing in rental properties. Thanks for watching.